How did the most powerful economy in the world come crashing down in 2008? How did Wall Street, once a symbol of American prosperity, become the epicenter of a global financial crisis? These are questions that have plagued economists, policymakers, and ordinary citizens alike. The failure of the bank system in America is a shocking business case study that continues to resonate with us today. It was a perfect storm of greed, lax regulation, and risky financial instruments that led to the collapse of some of the largest and most prestigious financial institutions in the world. In today's video, we will explore the causes and consequences of the failure of the bank system in America and discuss what we can learn from this historic event. From the rise of subprime lending to the burst of the housing bubble and the collapse of investment banks, we'll explore the events that led to the crisis and the lessons we can learn from it. But before we start, make sure you give this video a thumbs up, and if you're new to this channel, subscribe and hit the bell icon to stay connected. Let's get started. The rise of subprime lending. Subprime lending is a practice where financial institutions lend money to borrowers who have low credit scores or limited credit histories. These borrowers are considered higher risk, and thus, subprime loans come with higher interest rates and fees. While subprime lending has been around for decades, it wasn't until the early 2000s that it became a widespread phenomenon. During the housing boom of the mid-2000s, home prices in the U.S. rose by an average of 10% per year, and in some areas, such as California and Florida, they rose by as much as 20% per year. During the 2008 financial crisis, there was approximately $12 trillion worth of outstanding residential mortgage debt in the United States. In 2006 alone, there were over 2.3 million subprime mortgages originated, with a total value of $600 billion. By 2008, the foreclosure rate on these subprime mortgages had increased significantly, leading to a wave of home foreclosures and plummeting home values. A study by the Center for Responsible Lending found that subprime loans were often marketed to minority and low-income borrowers who were most vulnerable to predatory lending practices. These borrowers were often charged higher interest rates and fees and were more likely to fall behind on their payments and face foreclosure. As subprime lending grew in popularity, so did the housing market. Housing prices skyrocketed, and many people believed that real estate was a foolproof investment. But in reality, the housing market was experiencing a bubble, fueled by easy access to credit and speculation. The housing bubble eventually burst in 2008, triggering the subprime mortgage crisis. As borrowers began to default on their loans, the value of mortgage-backed securities plummeted, causing huge losses for investors. Banks were left with huge amounts of bad debt and were forced to write off billions of dollars in losses. In 2009, the peak year for foreclosures, there were 2.8 million foreclosure filings in the U.S. The rise of subprime lending and the subsequent collapse of the housing market and financial system had devastating consequences for the economy. Millions of people lost their homes, jobs, and life savings, and the effects of the crisis are still being felt today. By the end of 2010, an estimated 10 million families had lost their homes to foreclosure since the crisis began. The rise of subprime lending was a key factor in the failure of the bank system in America. The practice of lending money to high-risk borrowers led to a bubble in the housing market, which eventually burst and caused huge losses for banks and investors. The crisis serves as a reminder of the importance of responsible financial practices and the need for adequate regulation and oversight of the financial industry. The housing bubble and its aftermath. The housing bubble was one of the main culprits in the failure of the banking system in America. It was a period of rapid growth in the housing market that saw house prices skyrocket, fueled by a combination of easy credit, speculation, and a belief that real estate was a safe investment. One of the most glaring examples of the housing bubble was the market in Las Vegas, Nevada. In the early 2000s, the city experienced a boom in the housing market, with home prices rising at an unprecedented rate. By 2006, the median home price in Las Vegas had reached $313,000, up from $135,000 just 5 years earlier. This rapid increase in home prices was fueled by speculation, as investors bought up properties with the expectation of selling them for a profit in the near future. During the housing bubble, the total amount of outstanding mortgage debt in the United States increased from $4.8 trillion in 2000 to $10.6 trillion in 2007. The median home price in the U.S. peaked at $230,000 in 2006, up from $119,600 in 1999. By the end of 2010, the median home price had dropped to $166,100, a decline of more than 27%. The aftermath of the housing bubble was felt across the country, as the subprime mortgage crisis caused many people to default on their loans. The collapse of the housing market also led to a wider financial crisis, as banks and other financial institutions were left with billions of dollars in bad debt. The effects of the housing bubble and the subprime mortgage crisis are still being felt today, more than a decade later. Many homeowners who were impacted by the crisis are still struggling to recover financially, and the housing market in many areas of the country is still recovering. The role of investment banks. During the 2008 financial crisis, investment banks played a significant role in the failure of the banking system. Investment banks had been aggressively investing in high-risk mortgage-backed securities, which eventually led to the collapse of the housing market. These securities were comprised of subprime mortgages that were packaged together and sold to investors as a seemingly safe and lucrative investment. When these mortgages began to default in large numbers, the value of these securities plummeted, leading to massive losses for investors and banks. The failure of investment banks also had a significant impact on the overall economy. The total loss in stock market value from 2007 to 2009 was approximately $11 trillion, and the unemployment rate increased from 4.7% in 2007 to 10% in 2009. Investment banks also played a role in the widespread use of complex financial instruments, such as credit default swaps, which allowed banks to transfer risk to other parties. While these instruments were meant to help manage risk, they instead exacerbated the crisis when the underlying assets, such as subprime mortgages, failed. Furthermore, investment banks engaged in excessive risk-taking and leverage, which amplified the impact of the crisis. They used large amounts of borrowed money to invest in high-risk securities, creating a domino effect when the value of these securities collapsed. Despite the clear risks associated with these practices, the regulatory framework in place at the time was not effective in preventing the crisis. The Securities and Exchange Commission (SEC) had failed to adequately regulate investment banks, and there were no specific rules governing the use of complex financial instruments like credit default swaps. Additionally, the Federal Reserve had not set adequate capital requirements or limits on leverage, allowing investment banks to take on excessive risk. The regulatory framework also allowed investment banks to operate without the same level of oversight as traditional banks. Investment banks were not subject to the same capital requirements or regulatory oversight as commercial banks, leaving them with a greater ability to engage in risky practices without accountability. Investment banks played a significant role in the failure of the banking system during the 2008 financial crisis. Their aggressive investments in high-risk mortgage-backed securities, use of complex financial instruments, and excessive risk-taking and leverage all contributed to the crisis. Conclusion: it is crucial to understand the failure of the banking system in America and its impact on the economy. The 2008 financial crisis led to widespread job losses, home foreclosures, and a significant decline in economic activity. It serves as a reminder of the importance of responsible lending practices, effective regulation, and transparency in the financial system. As we move forward, it is essential to continue learning from past mistakes and take steps to prevent similar crises from occurring. This includes holding financial institutions accountable for their actions, implementing effective regulations, and promoting responsible lending practices. By doing so, we can ensure a stable and sustainable financial system that benefits everyone. Final words: what steps do you believe should be taken to prevent another financial crisis from occurring in the future? Let us know in the comment section below. If you liked the video, please don't forget to subscribe to the channel and press the bell icon. We will meet you soon in a new video. Until then, stay happy and take care of yourself.